Hello again, everybody. I wanted to provide a very quick video about the Strangle that I entered yesterday and then bought back today for a $250 profit. Very straightforward trade. When you are selling options, you're collecting a premium for those options, and that is known as a short position. In this case, given the fact that it was a strangle, that's the trading strategy. In essence, that becomes a short strangle trade. So that's what I did. Now, there's a lot of reasons that I entered the position that I entered, when I entered it, how I entered it, the metrics associated with it. But suffice it to say that I'm going to show you what I did, and I'm going to just kind of explain how the profit model was built. But my thesis going into it is relatively straightforward. I believed that the market was going to remain relatively stable, and I did believe that volatility going into the Fed announcement would either remain stable or become a little bit softer. In other words, it would go down a little bit, which are the ideal conditions for a strangle to become profitable. A short strangle. There's also a trade known as a long strangle, but we're not going to talk about that because that's not the trade strategy that I entered. So yesterday, and I don't remember exactly what time. As a matter of fact, I can check on that real quick, which would probably help to flesh things out. And, but it really doesn't matter when I entered it. I entered it yesterday. What I did is I entered the 25.75 strike price put. And you enter a short strangle by selling a call and a put in the same expiration cycle at different strike prices. So I'm going to sell a put. I'm going to sell the 25.75 put. So I click on the sell side of the put at the 25.75 strike price. Let me make sure I'm, right there, 25.75 strike price. And I'm in the May 18 with 9 days till expiration, next week's expiration cycle. And this is all of the fancy characters that assign the value, if you will, to, or the identifying value to this option chain. And that really doesn't make a whole lot of difference. So I've got the 25.75 strike price put, and now I want, and again, I'm showing you what I'm showing you because this is the trade I entered. So the 25.75 strike price put, and let me get the, there we go, get the option chain to the place where the strike is that I sold. And then I sold the 26.90 strike price call. So what that looks like is this lower. And let me make sure I'm giving you, so you can see how it's a strangle by virtue of how it's designated. You can see sell and sell in the options market as well as the stock market. You don't have to own something before you sell it, but when you sell something before you buy it, it's called a short position. So in essence, what I'm doing is I'm collecting premium when I enter a short strangle. So instead of having to pay for it, my account is being leveraged, if you will, by virtue of what is known as buying power, and that is collateralizing the premium I'm collecting and the risk that is associated with the position. Now, I'm going to collect $1,230 by entering this position. So now that's not 100% accurate. I would actually need to sell 2 of these in order to collect $1,230, which is what I did. So with that in mind, what I want to do is make sure that I'm doing this according to the math associated with how I actually entered the trade. And so you can see there's 2. So I haven't entered this trade. I'm showing you this for the purposes of demonstration. So I have 2 strangles, and they are set up at the 26.90 strike price calls and the 25.75 strike price puts in the May 18 contract of the S&P futures with 9 days till expiration. And I'm going to collect $1,230. That's $1,230 by entering this position. And if I am able to hold on to this trade and let it expire worthless, I will collect that entire $1,230. Now, this particular position was established as a trade, not something I was looking at for any other reason except a trade. It wasn't a hedge strategy. It wasn't anything other than me entering a position to make money on it. And every options contract expires. And I felt that for the strategy that I was employing, that this particular options contract, this particular expiration cycle would be the most advantageous for me to enter. And again, for an overnight trade, realizing $250 of profit, yeah, it was a great trade. So this is merely for the purpose of me providing you with what I did and what it looks like in an options chain and all of the particulars associated with it. There's a lot more to this trade. I could actually do an entire webinar on strangles. In fact, that's really a good idea. It's a very powerful and important trading strategy that everyone who trades the financial markets should really employ, but not until you understand it. And now I'm gonna sales pitch you here. Having someone such as myself, a trading coach, who can provide you with not only knowledge and the subsequent education that comes from that knowledge as it relates to applying that knowledge to a trading strategy, but also helping you understand how you as a trader can develop as a result of implementing trades like this and becoming profitable as a trader. This is but one of literally hundreds of strategies that are available. The key is to start small. Don't get confused. Don't get too excited. And know that there are certain strategies that are better in certain situations than others. But this one specifically tailored toward today's price action prior to the Fed announcement, and it played out perfectly. Yes, I collected a lot more, and I possibly could have made more money on the trade if I kept it longer. But the thing to realize with any kind of trade strategy and any time you put on a position, you really don't know what the market's going to do next. So there's no reason to take additional risk, to let your profits evaporate when they present, in the name of greed. Oh, I made $250. Maybe I can make $300 or $350. And then all of a sudden the market moves and now you're down. You're only up $100, or maybe you're even down. Maybe you are in the red $100. That's even worse. So at any rate, when the market did what it was doing and it gave me the profit that I felt was fair for me to receive from my trade strategy, I went ahead and exited the strategy, and I'm obviously very pleased. So I hope that helps a little bit. And just to go over it once again, so I'm selling the 26.90 call option. I'm selling the 25.75 put option, and I'm selling this, or shall I say, entering this trade strategy as a single trade. So if I were to enter this trade strategy, what I would do is I would go ahead and I would enter the trade by go ahead and confirming and sending it and putting it in my portfolio. But been there, done that. Not going to do that now. Watching the markets trading here in the extended session, they're kind of quiet. So not really interested in doing this trade. The environment in which this trade was designed for, as it relates to me and my thesis, was the market prior to the Fed announcement. So it all went well. At any rate, I hope that helps. If you have any questions, please let me know, and I'd be more than happy to answer those questions for you. All right, take care and good night.